Ever wondered how mutual funds work? If so, you're in the right place to get your answers. Mutual funds, in the simplest of terms, are a type of investment vehicle. They're akin to a large communal pot of money, where a multitude of investors pool their resources together. This pooled fund is then used to invest in a variety of securities. Now, these securities can range from stocks and bonds to money market instruments and other assets. Diving deeper into the types of mutual funds, we have equity funds, bond funds, and money market funds. Equity funds primarily invest in stocks. They offer high potential returns, but bear higher risks, as they are directly linked to the stock market fluctuations. Bond funds, on the other hand, invest in debt securities like corporate or government bonds and are generally considered safer than equity funds. They provide moderate returns and are less volatile. Money market funds are the safest among all, investing in highly liquid instruments like treasury bills and commercial paper. They offer modest returns and are perfect for conservative investors seeking stability. This way, each investor gets a slice of this diverse investment pie without the stress of individually managing each piece. Think of it as being part of gourmet dinner club, where everyone contributes a bit and in return gets to savor a lavish spread. There's no need to be a master chef or have the time to cook every dish. In the world of investments, mutual funds are the equivalent of this dinner club. So in a nutshell, a mutual fund allows you to invest in a diversified portfolio, even if you don't have the time or expertise to manage it yourself. All right, so we know what mutual funds are, but how do they really work? Let's break it down. It all starts with the fund manager. This person is like the captain of a ship, steering the mutual fund through the stormy seas of the financial markets. The fund manager's job is to make the tough investment decisions. They carefully select a variety of stocks, bonds, or other assets to include in the fund. They monitor the performance of these assets and make adjustments to the portfolio as needed to meet the fund's investment objectives. But how does the fund manager decide which assets to include in the fund? They use their expertise and experience to analyze market trends and economic data. They might also use sophisticated financial models to forecast future market movements. They aim to achieve a balance of risk and reward that aligns with the fund's investment strategy. Now you might be wondering, how do you know how much your investment in the mutual fund is worth? That's where the concept of net asset value, or NAV, comes in. The NAV is essentially the price per share of the mutual fund. It's calculated by dividing the total value of all the assets in the fund, minus any liabilities, by the number of shares outstanding. The NAV changes daily based on the performance of the assets in the fund. Let's say, for example, that a mutual fund has total assets of $1 million, no liabilities, and 100,000 shares outstanding. The NAV would be $10 per share. If the total value of the assets goes up to $1,100,000 the next day, the NAV would increase to $11 per share. It's important to remember that the NAV is not a measure of a mutual fund's performance. It's simply a snapshot of the fund's value at a particular point in time. That's it, folks. The fund manager makes the tough decisions, and the NAV tells you the current price of one share in the mutual fund. Scene script. Sounds pretty good so far, doesn't it? But what are the actual benefits of investing in mutual funds? Well, let's dive in, shall we? One of the most attractive features of mutual funds is diversification. By pooling your money with other investors, you're not just buying one stock or bond, you're buying a piece of a broad portfolio. This spread of investments can help to mitigate the risk associated with investing. Think of it as not putting all your eggs in one basket. Next up, we have professional management. When you invest in a mutual fund, you're essentially hiring a team of professionals to manage your investment. These financial experts research, select, and monitor the performance of the securities your fund invests in, so you're getting the benefit of their expertise and experience without having to do the heavy lifting yourself. Now, what about the small investor who doesn't have a ton of cash to throw around? Well, mutual funds have got you covered. They often have low minimum investment requirements, which makes them accessible to the average Joe or Jane. This means that even with a small amount of money, you can start building your investment portfolio, and let's not forget about the potential for higher returns. While there's always risk involved in investing, mutual funds can provide a higher return on investment compared to traditional savings accounts. That's quite a list of benefits, isn't it? But like everything in life, mutual funds also have their downsides. So what's the catch with mutual funds? Let's dive into some of the potential cons. First up, fees and expenses. Mutual funds are managed by professionals and they don't work for free. These experts charge management fees, which can eat into your returns. There are also other costs like transaction fees, marketing fees, and more. Over time, these fees add up and can significantly reduce your overall returns. Next, let's talk about control, or rather, lack thereof. When you invest in a mutual fund, your money is pooled with other investors, and the fund manager makes the decisions about what to buy and sell. This means you have little to no control over the specific investments in the portfolio. If the fund manager makes a decision you don't agree with, there's not much you can do about it. Finally, there's the big one, the potential for losses. Just like any other investment, mutual funds come with risk. If the market goes down, your mutual fund investment can go down with it. And since you're investing in a basket of different investments, a downturn in one sector could affect your entire portfolio. Remember, mutual funds are not a guaranteed path to wealth. They have their advantages, but they also come with potential pitfalls. It's important to be aware of these potential downsides before you invest in mutual funds. So, we've taken a whirlwind tour of the world of mutual funds. Let's recap what we've learned. Mutual funds, in essence, are a financial vehicle that pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They work by delegating the investment decisions to a professional fund manager, who leverages their expertise to aim for the best possible returns. The pros of mutual funds include diversification, professional management, and the flexibility of buying or selling your shares on any business day. On the flip side, the cons include management fees, potential for underperformance, and the lack of control over individual investment decisions. Mutual funds can be a solid choice for investment, but it's crucial to comprehend their workings and the associated risks. Remember, knowledge is power when it comes to investing. So keep learning, keep investing, and let your money work for you.